the way we can value this
Yeah.
is we can value this based on what the market values similar things, right? You can one way to put a valuation on it is relative valuation. Right?
Okay.
You do this in the stock market too, right?
Yeah.
So,
yeah.
So hey, say that,
so let's do this. Let's do an example of a stock that everyone is familiar with, of how you do the valuation on that, and then we'll switch it over and do the one for Lisk. That way, the audience knows what we're talking about. Because remember, if we talk about something they don't know about, then it's not going to make any sense. So let's.
All right. So let's take an example of what's a good example that everyone would know? All right.
How about Airbnb
in
or
the stock market,
Uber?
Okay. Let's look at something that's been traded for a while. Let's look at Google, right? Google's been out for a while, and okay, so we know the concept of PE, right? We know the concept of price to earnings ratio, right?
Mm-hmm.
In the stock market, you hear about the PE is a statistic that's quoted, very commonly quoted, right?
Yeah, I never care about that number when I'm trading.
I know, but it's important, right? It's the reason that you might not care about it because you just look at the charts, but from a fundamental analysis, it tells you what investors are willing to pay for a company, right? At any given moment, right?
Yeah.
So if you look at, say, a price to earnings ratio, what that number means is how many dollars are investors willing to pay for a dollar of earnings of that company, right?
Yeah. So if that company has $1 worth of earning, and the price
how many dollars are investors willing to pay to get that dollar of earnings, right?
Yeah.
All right. So if you take a company, say, like a General Motors, right?
Yeah.
The company the market values GM at 9, gives it a P of 9, right? Which means that the market is willing to pay $9, right, for every dollar of GM's earnings, right? Or something like Caterpillar or something. Typically 9, 10. That's 9, 10, 11. 7, 8, 9, 10, 11. That's something for like old, established, traditional companies. That's typically like the multiple they get. Right?
Yeah, so it's about 9 or 10 times the earnings.
Yeah. So the stock price divided by the earnings, you get a multiple about 10, right? Let's just call it 10.
Yeah, that way that the listeners know what the average is. So it's around 10. 10 times.
And I think like the S&P 500 trades at an average of 18 or something like that, 15 to 18 historically, right? I mean, I don't know what it is right now, but 15 to 18, like when we were at the peak of the bubble, it got as high as like 25, and when you're in like a depression, it can get down to like 9, right? But in the normal, the long-term average tends to be around 15, right? 15 to 18, something like that. So when Google came out in 2004, I think it was, they came out at a 50 multiple, right? In other words, the market was willing to pay $50 for every dollar of Google, right?
Yeah.
And so the question you would ask yourself, why is the market willing to pay $50 for $1 of Google's earnings and only, say, $10, 9 or 10 for $1? It's the same dollar of profit, right?
Yeah.
So why is it that for, say, a GM, the market is only willing to pay 10, but for a company like Google, the market is willing to pay 50?
Because at that time they believed that it had more potential.
Well, because the PE is looking at the past, right?
Yeah.
The PE is looking at the way you calculate PE was for the past 12 months. How many dollars did the company earn per share?
Yeah.
Divided by the stock price, right? The stock price divided by the earnings for the last year.
Yeah.
That's a backward-looking number, right? It's telling you what has been, not what.
Yeah, it's based on facts. It's not based on opinion.
Yeah, it's based on the facts that have already happened.
Yeah.
Right.
Yeah.
That's not how stocks trade, right? Stocks trade based on what the market believes the future is going to be, not based on what has already happened. It's based on what the market thinks is going to happen.
Yeah, like so when I'm trading, if you pull up a GE stock or GM stock or Apple stocks, I'm trading it based on where I expect it to be.
Yeah, exactly. So the market is saying basically that I'm willing to pay $50 for a multiple of 50 because the market believes Google is going to grow a lot faster than, say, a General Motors.
Yeah.
And in 2004, it actually did. In fact, if you paid 50 times earnings, they said the forward multiple, from 2004, what actually ended up happening was you were actually only paying $6 for what happened in the future. Like, there's no way you could have known in 2004, but the next years, you actually paid something like it was cheaper than anything. Like, even paying 50 times earnings for Google was less than anything you could have bought, and that's why Google has outperformed so much, right? That's one way to look at valuations is you can look at what is the multiple of say a Google or a Facebook versus say a multiple of if you have like a company like Uber or any other tech company, right?
Yeah.
And so I have a friend who gave me this example, right? He said, you know what, I can open a trucking company. Like he's trying to do something like Uber for construction vehicles, right?
Yeah, for like dump trucks.
Dump trucks.
And cement trucks.
Cement trucks, right? So stuff like that, right?
Yeah.
And he was saying that, I could open a traditional cement or trucking company, right?
Yeah.
And if let's say I built this business and it makes $1 million a year and I wanted to sell it, right?
Yeah.
I could probably only sell it for between $1 and $2 million, right? If it made $1 million a year,
yeah,
and I wanted to sell the company, I could probably only sell it for no more than a few $1 million, right?
Yeah.
But if I make a tech company, let's say I make like an Uber for dump trucks, a trucking tech company that is based around an app, like Uber, right? Because Uber is basically a taxi company, but they don't own any taxis; they just own an app, right?
Yeah.
But if I built like an app for dump trucks, right? And I built this business that it made $1 million a year, just like I built a traditional company. Like he said, I could sell this company for $20 million, not for 2 or 1.
Yeah.
And I was like, well, why? Right? You get what I'm saying? Like,
yeah.
Why would you be able? Like, you're building basically a trucking company, and just because this tech company has an app, you can sell it for 20 times the profit versus if you just ran a regular. But you get what I'm saying? If you just opened a regular company and bought trucks and made the same amount of money, right?
Yeah.
You could only get $2 million for making the same amount of money, right?
Yeah.
And I was like, well, why is that? And he's like, well, I don't know why. That's just what the market says, right?
Yeah.
So